As we move into the final days of January 2026, Jerome Powell delivered what most market participants expected at the Federal Open Market Committee meeting on January 28th. A pause on interest rate cuts, holding the federal funds rate steady at 3.5 to 3.75%. CNBC, I'm not a financial advisor. This isn't financial advice. This is an educational analysis based on publicly available information and historical precedent. What happened in that Washington conference room, however, reveals two seismic structural shifts that almost everyone is missing in their rush to analyze the rate decision itself. These are not bombshells in the theatrical sense, but in the systemic sense, the kind that reshape the architecture of central banking and economic stability for decades to come. The first bombshell is structural and mathematical. Powell stated explicitly that the federal funds rate is now loosely neutral, and that many of his colleagues believe it is hard to look at the incoming data and say that policy is significantly restrictive at this time. Fox Business, CNBC, this is not a minor technical adjustment. This is the Federal Reserve Chairman telling the world that after cutting rates by a full percentage point across 3 consecutive meetings in late 2025, monetary policy has effectively exhausted its traditional cushion. When a central bank operates in restrictive territory, it has room to maneuver. It can cut rates to stimulate growth, ease credit conditions, and support employment without immediately triggering inflation. But when policy is at neutral, or as Powell described it, somewhere between loosely neutral and somewhat restrictive, in the eye of the beholder, Fox Business, the Fed has lost that buffer. What makes this revelation so consequential is not where rates are today, but where the economy is positioned relative to what comes next. The neutral rate represents the theoretical equilibrium where monetary policy neither stimulates nor restrains economic activity. It is the Goldilocks zone of central banking. But here is what history teaches us about neutral rates during periods of elevated inflation, political pressure, and structural economic transition. They do not stay neutral for long. They either become restrictive as inflation accelerates, forcing the central bank to slam on the brakes, or they become accommodative as recession takes hold, forcing emergency cuts that arrive too late to prevent significant damage. The mathematics of this are unforgiving. The Federal Open Market Committee cut the benchmark federal funds rate 3 times for a total of 75 basis points in 2025 to land at 3.5% to 3.75%, in part because of concerns about the weakening labor market. The street. The Fed moved aggressively to preempt deterioration, but by arriving at neutral so quickly, they have painted themselves into a corner. If the labor market weakens further, as suggested by Powell's acknowledgement that the last 3 jobs reports showed average declines of 22,000 jobs per month, Fox Business, the Fed, will need to cut rates into accommodative territory while inflation remains above target. If inflation reaccelerates, particularly from sources beyond tariffs, the Fed will need to hike rates back into restrictive territory while employment is softening. Either scenario creates the conditions for what economists call policy error, the kind that turns slowdowns into recessions and recessions into crises. The neutral rate trap is not new. We saw it in 2007, when the Federal Reserve believed it had engineered a soft landing, only to discover that the housing market collapse required far more aggressive intervention than anyone anticipated. We saw it in the 1970s, when the Fed repeatedly declared victory over inflation while operating near neutral, only to be forced into the Volcker shock of 20% interest rates to finally break the cycle. The pattern is always the same. Central banks arrive at neutral, declare the hard work done, and then discover that neutral is not a destination, but a tightrope, and the winds are picking up. Powell acknowledged that elevated inflation readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs, while disinflation appears to be continuing in the services sector. Fox Business, CNBC. This bifurcation is critical. Goods inflation driven by tariffs is, in theory, transitory. It represents a one-time price level increase that should peak and then stabilize. Powell expects tariff inflation to top out sometime in the middle quarters of 2026, assuming there are no new major tariff increases. Yahoo Finance. But services inflation, which comprises roughly 2/3 of the consumer price index and is heavily driven by wages, is far stickier. It does not respond quickly to monetary policy, and it does not reverse easily once embedded in expectations. The Fed is essentially betting that goods inflation will fade while services inflation continues to decelerate, allowing overall inflation to glide smoothly back to 2%. This is the best-case scenario. It is also historically rare. More common is the scenario where one-time price shocks become embedded in expectations, where businesses use tariffs as cover to raise prices more broadly, where workers demand wage increases to compensate for higher costs, and where the inflation psychology shifts from temporary to permanent. Once that shift occurs, the neutral rate is no longer sufficient to contain price pressures, and the Fed must choose between tolerating higher inflation or engineering a recession to break expectations. This brings us to the second bombshell, and this one is institutional rather than economic. When asked why he attended the Supreme Court oral arguments in the case involving Federal Reserve Governor Lisa Cook, Powell stated that the case is perhaps the most important legal case in the Fed's 113-year history. CNBC, this is not hyperbole. This is the chairman of the Federal Reserve telling the world that the independence of the central bank, the foundational principle that has underpinned American monetary policy since the Federal Reserve Act of 1913, is under existential threat. The Lisa Cook case centers on whether President Trump can fire Federal Reserve governors for cause without meaningful judicial review, based on allegations that have not been proven and do not constitute formal charges. CNBC. But the real issue is not Lisa Cook. The real issue is whether a president can remove any Fed official who refuses to comply with White House demands on interest rates. Powell revealed on January 11th that the Department of Justice served the Federal Reserve with grand jury subpoenas threatening a criminal indictment related to his testimony before the Senate Banking Committee about the central bank's headquarters renovation project. Federal Reserve NPR Powell called this unprecedented action part of a broader pressure campaign, stating explicitly that the threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. NPR. We are witnessing, in real time, the erosion of the institutional firewall that separates monetary policy from political control. This is not a partisan observation. It is a structural one. Every advanced democracy has converged on the same institutional design for central banking: independence from elected officials in the execution of monetary policy, combined with democratic accountability through legislative oversight and transparent communication. The reason for this design is not to protect central bankers. It is to protect the currency. Politicians face election cycles. Central bankers face inflation cycles. These operate on fundamentally different time horizons. A politician seeking re-election has every incentive to push for lower interest rates in the short term, even if those lower rates fuel inflation that will damage the economy in the long term. This is not a moral failing. It is an incentive structure. The solution, developed over a century of economic catastrophes, is to insulate monetary policy decisions from short-term political pressure while maintaining accountability through appointments, congressional testimony, and public communication. When that insulation breaks down, the consequences are mathematically predictable. During the Supreme Court oral arguments, Justice Brett Kavanaugh warned that allowing the president to fire Fed governors without meaningful judicial review would weaken, if not shatter, the independence of the Federal Reserve. NPR Kavanaugh, often a key swing vote, expressed concern about the real-world downstream effects, noting that all of the current president's appointees would likely be removed for cause on January 20, 2029 if there is a Democratic president, and then we are really at-will removal. NPR. This is the slippery slope in its purest form. Once the precedent is established that a president can remove Fed officials who do not comply with White House preferences, every future administration will use that tool. The result is a Federal Reserve that operates not based on economic data and mandated objectives, but based on who controls the White House and what their short-term political needs require. History provides clear examples of what happens when central banks lose independence. In Turkey, President Erdogan repeatedly fired central bank governors who refused to cut interest rates despite high inflation. The result has been a lira that has lost more than 90% of its value since 2013 and inflation that peaked above 80%. In Argentina, decades of political control over monetary policy produced a peso that has undergone multiple devaluations and inflation that regularly exceeds triple digits. In Venezuela, the collapse of central bank independence was one of several factors that contributed to hyperinflation, exceeding 1,000,000%. These are not distant historical examples. These are contemporary economies where the breakdown of institutional independence produced currency collapse and economic devastation. The United States is not Turkey, Argentina, or Venezuela, but the mechanisms are the same. Once political pressure can override monetary policy judgment, market participants adjust their expectations accordingly. They begin to price in higher inflation risk. They demand higher yields on government bonds. They move capital to safer jurisdictions. These adjustments happen gradually at first, then accelerate as confidence erodes. The bond market does not wait for hyperinflation to materialize. It prices in the risk long before. What makes the current situation particularly dangerous is the confluence of these two bombshells. The Federal Reserve has arrived at neutral rates with inflation still above target and a labor market showing signs of weakness, which means it has very little room to maneuver. Simultaneously, the institutional independence that would allow it to make difficult decisions without political interference is under the most severe pressure in the modern era. These conditions create what systems theorists call a fragility trap. The system appears stable on the surface. GDP growth remains solid. Unemployment is relatively low. Markets are near all-time highs. But beneath the surface, the structural buffers that prevent small shocks from becoming large crises have been depleted. The Fed cannot cut rates aggressively without risking an inflation resurgence. It cannot hold rates steady without risking labor market deterioration. And it cannot make either decision without facing intense political pressure that undermines its credibility. This is why outcomes that feel sudden are actually mathematically earned. The collapse of Bear Stearns in March 2008 felt sudden, but it was the inevitable result of leverage ratios that had been climbing for years, risk management systems that had been weakened by regulatory capture, and a housing market that had been mispricing risk for more than half a decade. The sovereign debt crisis in Europe that exploded in 2010 felt sudden, but it was the inevitable result of monetary union without fiscal union, current account imbalances that had been building since the euro's creation, and debt-to-GDP ratios that made default mathematically certain once growth slowed. The current situation follows the same logic. We have a central bank operating at neutral rates with no room for error. We have inflation that remains above target and is partially driven by structural forces like tariffs that may not be temporary. We have a labor market that is softening but not collapsing, creating ambiguity about whether intervention is needed. And we have an institutional framework under assault from political forces that want control over the one lever that has historically been kept separate from electoral politics. The people who will be most affected by this are not financial market participants. They have the tools and resources to hedge their exposure, move capital across borders, and adjust their portfolios to changing conditions. The people who will be most affected are those who hold their wealth in dollar-denominated assets, who rely on stable prices for basic necessities, and who have no ability to protect themselves from currency devaluation or inflation acceleration. This includes retirees on fixed incomes, workers whose wages do not adjust quickly to inflation, small business owners who cannot pass costs to customers, and savers who believed that dollar-denominated bank accounts represented safety. When central bank independence erodes, These groups bear the cost. When monetary policy operates at neutral with no buffer, these groups bear the cost. When inflation expectations become unanchored, these groups bear the cost. The mathematics of this are not speculative. They are historical. Every major inflation episode in the past century, from Weimar Germany to 1970s America to contemporary Turkey, followed the same pattern. Political pressure on central banks, erosion of independence, loss of credibility, acceleration of inflation expectations, and wealth destruction for those least able to protect themselves. The fact that this process happens gradually, that each individual step seems manageable, that officials can point to stabilizing indicators and declare the situation under control, does not change the mathematics. It only ensures that by the time the problem becomes undeniable, the solutions have become far more painful. Federal Reserve Governors Stephen Moran and Christopher Waller voted to cut interest rates by 25 basis points, dissenting from the majority decision to hold rates steady. Yahoo Finance. This split decision reveals the depth of disagreement within the Federal Open Market Committee about the appropriate path forward. Waller, who is considered a potential nominee to replace Powell as Fed chair when Powell's term expires in May, has signaled through his dissent that he believes the risks to employment outweigh the risks from inflation. Moran, appointed by Trump and consistently voting for more aggressive cuts, represents the White House's preferred policy stance. The fact that two governors are voting for cuts while the majority holds steady is not a sign of healthy debate. It is a sign of a committee fracturing under the weight of contradictory pressures. This fracturing matters because monetary policy effectiveness depends on credibility and consistency. When the Federal Reserve sends mixed signals, when market participants cannot discern a clear reaction function, when political appointees vote consistently against the consensus, expectations become unanchored. Businesses do not know whether to plan for higher or lower borrowing costs. Consumers do not know whether to accelerate purchases or delay them. Investors do not know whether to position for growth or contraction. This uncertainty itself becomes a drag on economic activity, creating the very conditions that make policy errors more likely. The historical parallel that should concern anyone paying attention is not the dramatic collapse of Lehman Brothers in September 2008, but the slow erosion of Federal Reserve credibility in the 1970s. That erosion did not happen overnight. It happened through a series of small compromises, each of which seemed reasonable in isolation. The Fed cut rates to support employment even as inflation began to accelerate. It declared victory over inflation prematurely, only to be forced to tighten again. It responded to political pressure from the Nixon and Carter administrations to prioritize growth over price stability. Each decision was defensible based on the data available at the time. Each decision was presented as a necessary balance between competing mandates, and each decision contributed to the eventual outcome: inflation that reached double digits, interest rates that exceeded 20%, and a recession that was deliberately engineered to break inflation expectations because no other tools remained. We are not in the 1970s. The economy is different. The institutional framework is different. The level of inflation is different. But the mechanics of how central banks lose credibility and how that loss of credibility accelerates into crisis are identical. It begins with operating at neutral rates with no room for error. It continues with political pressure that undermines independence. It accelerates when inflation becomes embedded in expectations. And it culminates in a choice between tolerating persistently high inflation or engineering a painful recession to restore credibility. The reason most people miss this dynamic is that the signals are subtle until they are not. Powell's statement that the point of independence is not to protect policymakers, but that every advanced economy and democracy in the world has come around to this common practice, because it is an institutional arrangement that has served the people. Well, CNBC is the kind of statement that gets lost in the coverage of rate decisions and economic projections. But it is the most important thing he said. He is telling anyone who will listen that the institutional foundation is under attack, that this attack is unprecedented in the modern era, and that if that foundation crumbles, it will be very difficult to restore the credibility of the institution. The scale of potential wealth destruction from this convergence of factors is not something that can be quantified precisely in advance. But we can look at historical episodes where similar dynamics played out. In the 1970s, the combination of supply shocks, political pressure on the Fed, and loss of monetary policy credibility produced a period where real returns on stocks were negative, bond portfolios were devastated, and the purchasing power of the dollar declined by roughly 50%. In the European sovereign debt crisis, the loss of confidence in institutional frameworks produced bond yields that spiked from 3% to over 7% for Italian and Spanish debt within months, destroying trillions in wealth and requiring emergency intervention from the European Central Bank. In emerging market crises from Mexico in 1994 to Turkey in the 2010s, the erosion of central bank independence produced currency collapses that wiped out dollar-denominated wealth holdings for entire populations within years. The United States has structural advantages that these other examples lacked. The dollar is the global reserve currency. U.S. Treasury bonds are considered the safest asset in the world. American capital markets are the deepest and most liquid. These advantages provide a buffer that allows the system to absorb shocks that would devastate other economies. But these advantages are not permanent. They exist because of institutional credibility. They persist because market participants believe that the Federal Reserve will prioritize price stability and maximum employment over political expediency. They endure because the rule of law and separation of powers prevent any single political actor from capturing the monetary policy apparatus. When those beliefs begin to erode, when market participants start to price in the possibility that the Fed will be pressured into keeping rates too low for too long, when foreign investors begin to question whether dollar-denominated assets will maintain their purchasing power, the advantages start to diminish. This does not happen overnight, but it does not take decades either. The loss of reserve currency status can happen over the course of years once the process begins. The British pound's decline from global reserve currency to regional currency took roughly 2 decades following World War II, but the sharpest deterioration occurred in concentrated periods of crisis when institutional credibility collapsed. The common objection to this analysis is that the U.S. economy looks strong, that unemployment is low, that growth continues, and that therefore concerns about institutional erosion are overblown. This objection misunderstands the nature of systemic risk. Systemic risk is not about current economic conditions. It is about the buffers and institutions that allow the system to absorb shocks. A building can look perfectly sound right up until the moment the foundation fails. A bridge can carry traffic normally right up until the point that structural fatigue causes collapse. The economy operates the same way. When the Federal Reserve has room to cut rates by several percentage points, it can respond to recession without hitting the zero lower bound. When the Fed has unquestioned independence, it can make unpopular decisions that cause short-term pain but prevent long-term crisis. When inflation expectations are anchored, temporary price shocks dissipate without becoming embedded. These are the buffers, and they are being depleted in real time. Powell's 2 bombshells are not about what is happening to the economy today. They are about what becomes possible when the next shock arrives, when a geopolitical event disrupts energy markets, when a financial institution fails due to hidden leverage, when a debt ceiling crisis creates fiscal uncertainty, when any of the dozens of potential shocks that constantly threaten complex systems actually materialize. At that moment, the Federal Reserve will need to respond. It will need to cut rates aggressively, or raise them decisively, or provide emergency liquidity, or signal absolute commitment to price stability. And the effectiveness of that response will depend entirely on whether it has room to maneuver and whether it has the institutional credibility to be believed. Right now, as we enter February 2026, the Federal Reserve has told us it is operating at neutral with no buffer. and it is facing the most significant threat to its independence in modern history. These are not predictions. These are current conditions. The disaster does not require forecasting. It requires understanding that systems positioned this way, with these pressures, facing these constraints, do not gradually return to stability. They break, sometimes slowly, sometimes suddenly, but always in ways that feel inevitable in retrospect and surprising only to those who refuse to see the architecture of collapse being assembled piece by piece in front of them,